The real estate market has always been the subject of fascination, speculation, and concern. After the dramatic crash of 2008, people have remained weary of another potential collapse, especially now that we've gone through years of amazing upcycle. In this video, we'll dive into the factors that influence the real estate market, examine historical trends, and explore the question on everyone's mind: when will the real estate market crash again? Hey, quick introduction. My name is Mac Rogers. I'm a real estate broker here in the San Francisco Bay Area. Welcome to the channel. If you like this content, please consider subscribing and hit the thumbs up button. I believe that one of the biggest factors that people are afraid of is another housing bubble like what happened in 2008. The 2008 real estate market crash left a lasting impression or impact on economies worldwide. It was triggered by a combination of factors including subprime mortgage lending, inflated home prices, and complex financial instruments. Let's look at subprime lending, which, to be honest, should be described as more of garbage lending standards. I was there and I saw it firsthand. I mean, it's not an exaggeration. Here's one example of a subprime mortgage product: Ninja loans. Ninja loans were a type of mortgage lending that stood for no income, no job, no assets. These loans allowed borrowers to get approved for mortgages without providing proof of their income, employment status, and assets. That's right, you don't have a job, you don't have assets, you get a loan, $500,000 or more. This lax lending standard, if we can call it a standard, led to a surge in risky loans as borrowers got mortgages far beyond their actual ability to repay. This easy money led to the next domino falling, which is inflated home prices. There was a false sense of affordability. When lenders make borrowing money easier, it creates a sense of affordability that might not reflect the actual financial realities. During that time, it wasn't so much as mortgage rates were low, but rather the lending standards were lenient. More people can qualify for loans, leading to an increase in demand for homes. Now, before you say, wait a second, if there's demand, shouldn't that be good? The thing was, it wasn't true demand. It was speculative. People were buying houses because they wanted to sell it the next year, heck, some of them even 3 to 6 months later, and make at least 50%. Yes, it was a Ponzi scheme of some sorts. This surge in artificial demand drove up home prices artificially. Now, all this was done with the help of Wall Street and the complex financial instruments that they created. The movie The Big Short gives you a great overview of this whole thing. I suggest checking it out. It's actually free on YouTube. Let me give you a quick and dirty overview. There's this thing called mortgage-backed securities, or MBS. There are different types, but for our purposes, I'll just lump them together. It's not important for this video. It's a financial instrument or security that financial institutions such as banks and mortgage lenders use to originate a large number of individual mortgage loans from various borrowers. These loans are then pooled together to form a package. This pool of mortgage is then securitized into tradable securities. Now, these securities are then sent to rating agencies such as Moody's, Standard & Poor's, and Fitch, and they are assigned a credit rating. They are rated for various factors such as borrower creditworthiness, interest rate fluctuations, and macroeconomic conditions, etc. Basically, the credit rating agencies just assigned high ratings on all the risky loans that was getting securitized. Loans like Ninja loans, negative amortization loans, borrowers with low credit scores. All these loans were deemed to be low risk when they were all pooled and bundled together. And then we imploded. So that was 2008 in a nutshell. I'm happy to say that none of these things are going on right now. There are no risky loans happening. Whether we're talking about exotic loan types or risky borrowers, in fact, we have very strict lending standards right now. I saw the other day that the average credit scores of mortgage borrowers right now are in the high 700s. That wasn't the case before. Also, in the aftermath of the 2008 crisis, regulatory reforms were implemented to improve the transparency and accountability of MBS. The Dodd-Frank Wall Street Reform and Consumer Protection Act introduced measures to enhance the quality of mortgages included in MBS and to provide investors with more accurate information about the underlying assets. The next factor that influences the real estate market are market cycles. Real estate, like any market, experiences cycles of boom and bust. Historically, these cycles tend to last around 7 to 10 years. Now, those are not exact numbers. These cycles are driven by a combination of economic, financial, demographic, and psychological factors. The cycles typically include the following phases. The recovery phase marks the end of a downturn or recession in the real estate market. During this phase, economic conditions begin to improve, consumer confidence rises, and demand for real estate starts to increase. Prices stabilize and might even experience modest growth. From my experience, the current real estate market boom that we have started in 2010, at least here in the Bay Area. During that time, I remember prices started stabilizing, and some of my clients, when they were buying properties, we actually started to have competition. Now, let me just clarify this. There were a lot of properties for sale. However, most buyers were always looking for the best properties with the best prices. So you tend to have competition for those properties. The next phase of the cycle is expansion. The expansion phase is characterized by strong economic growth, low unemployment rates, and increasing demand for real estate. As consumer and investor confidence rises, property prices and sales activity experience significant growth. New construction and development projects become more common. I saw this happening around 2014. By this time, there were rumblings that we were starting to overheat again. The 2008 meltdown was still fresh in people's minds, and quite frankly, people were still cautious. By 2017 and 2018, there was a general feeling that we were really in dangerous territory again. I kind of believed this back then. In fact, I switched most of my marketing to attract as many buyers as I can because I thought there were going to be less buyers out there. Well, that blew up in my face. 2018 and 2019 was just crazy. Okay, moving on to the next phase. It's hyper supply or overbuilding. This would be the brand new homes. During this phase, the market becomes flooded with new construction projects as developers try to take advantage of the high demand from the expansion phase. If the supply exceeds the actual demand, it can lead to an oversupply of properties, resulting in stagnating or declining prices. According to the data that I have seen, this is not happening right now. Simply put, there is no overbuilding going on. Now, that's the national average data. It doesn't mean that regionally there are no places that's getting overbuilt. On one of my previous videos, I mentioned Texas, Arizona, Florida, and Nevada as places that might have overbuilding. The reason I mentioned these states is because these states have historically been the places where they can just build like crazy. You go to the suburbs of Houston, Austin, or San Antonio, and you see development after development. Same goes for the other states that I mentioned. Here in the Bay Area, technically there's no overbuilding going on either. Brand new homes are still selling. In some cases, it's slowing down and builders are starting to offer incentives again. But generally, so far, there is no oversupply. Next phase in the cycle is recession or contraction in the economy. The recession phase is a slowdown in the economic growth, often characterized by rising unemployment. We don't have this yet. A decrease in consumer spending. I think there's an argument to be made about this as people are cutting back on spending, especially when it comes to spending that involves financing. Property prices begin to decline as demand weakens and oversupply becomes evident. Definitely not happening yet. This phase can be triggered by various factors such as rising interest rate, definitely yes, economic shocks. I do think that we have a mini economic shock that's going on, and it could turn into a financial crisis. Next phase is the trough. The trough marks the lowest point in the real estate cycle. Property prices bottom out and sales activity is generally slow. During this phase, many investors and developers might exit the market due to pessimism about the market's potential for growth. I don't want to go through this again unless I have lots of money to just start buying in cash. During the mortgage meltdown, this happened around 2009-2010. That's here in the Bay Area. Again, that's my experience. I'm not saying that happened the same time in the whole country. And finally, the last phase, back to recovery. After reaching the trough, the cycle starts over with gradual recovery. Just like my example for 2010, economic conditions slowly improve and property prices stabilize before beginning to rise again. This phase sets the stage for the next expansion phase. The thing to note is that the duration and intensity of each phase can vary based on factors such as local economy, supply and demand dynamics, interest rates, and government policies. Also, real estate cycles don't always follow a perfectly predictable pattern, as unexpected events and external factors can disrupt the cycle, like COVID. I mean, look, If you believe my thinking of this expansion cycle started back in 2010, that would mean that we are either 6 years or 3 years overdue for a correction. For me, cycles in real estate is not that important if you are buying a home for you to live in. If you're going to stay in your home for 10, 20, 30 years, the reality is that you have time on your side. And I would even argue that if you are buying for investment purposes, as long as your time horizon is over 10 years, I'd say again, time is on your side. Okay, so we looked into the past, and so far 2008 or the mortgage meltdown is not the same as what we have right now. Then we looked into the market cycles, and I think we can pretty much infer we are deep into expansion, and dare I say, the last leg of this expansion. Now let's look at current market indicators. Examining current market real estate indicators can provide insights to its stability. Factors such as supply and demand, inventory levels, lending practices, and buyer demographics all play a role. As of this video, we know supply and demand is imbalanced. We have more demand than inventory. Lending practices are very good. The demographics of our buyers are also good. In fact, we have 72 million millennials that will be and are ready to form their own households. After them, nearly 68 million Gen Zs that will also start their own lives and most likely also want to be able to own their own home. So if we look at current market indicators, we look good. This real estate market is strong, but what we have is an affordability issue, which brings me to interest rates and economic factors. I don't have to say this, but you know that interest rates are a critical driver of real estate market stability. When rates are low, borrowing becomes more accessible, boosting demand for housing. Conversely, high rates can deter buyers and slow down the market. The health of the overall economy also has a significant impact on the real estate market. Job growth, consumer confidence, and GDP growth all contribute to the stability of the market. Right now, the Fed seem to be sending us directly into a recession as they continue their relentless push to drive inflation down. Like I said, higher interest rates are keeping consumers on the sidelines. Eventually, demand goes down, production goes down, then we have cutbacks, layoffs, and boom, full-blown recession. But there is a silver lining with recessions. Interest rates and by extension, mortgage rates starts going down again. Okay, the final topic before I land this plane that I want to talk about is regional variations. If you watch my videos, I've always said that it's important to remember that the real estate market is not one big giant monolith. Regional variations can significantly affect market stability. While one area might experience a slowdown, another could be thriving. Factors such as job growth, population trends, and local industries all contribute to these variations. In conclusion, the question when the real estate market will crash again remains a mystery. While historical patterns and indicators can provide insight, the market is a complex interplay of economic, social, and technological factors. This current market that we have is a perfect example of this complex interplay. We have indicators that say we should be headed off the cliff, but other indicators are saying this is a strong market. Like I keep saying, instead of obsessing over predicting the future, a more constructive approach is to focus on understanding your needs and your goals. Because as of now, the real estate market continues to evolve, with some areas still experiencing rapid growth while others grapple with affordability challenges. Ultimately, staying informed, staying adaptable, and understanding that no one can perfectly predict the future will serve as the best strategy in navigating this crazy real estate market. Thanks for watching.